So the paper title is Fundamentals of Management Accounting. So what are the areas where we would be looking at? We are going to learn about what is management accounting, the context of management accounting, cost accounting, some issues related to cost accounting, planning and controlling. So the various things, whatever has to be learned. Then decision making. This is the summary of the syllabus. To begin with, what is management accounting? The context of management accounting. We're going to learn about what is the role of management accountant, purpose of management accounting, the global management accounting principles. So in your college, you must have learned about the principles of accounting. Principles of accounting. Now they are the same uh, across the globe. So everywhere it's the same thing, but maybe the presentation part of it is a little different. But these are the basic basis for all the other things. So the principles of accounting are the same across the earth or the world. What does it mean by the global management accounting principles? CIMA together with American AICPA, they have developed the global management accounting principles which should be used to guide best practices in management accounting. So let's discuss about what they are. Influence, relevance, trust, value. Global management accounting principles. The first one, influence. It says that communication provides insight that is influential. Your first years, no, those who have already done, even you understand that what is that framework which starts from collection of information. This information is analyzed ultimately to have an influence. So the the first part of it is the communication provides insight that is influential. So the information which is collected, that's analyzed, then that is those insights are provided to provide to advise so that there can be an influence. So that's a framework which you would be learning in even. So the information whatever is gathered, that is communicated to others so that there can be an influence on in the organization. Then relevance talks about information that is gathered gathered and analyzed, that should be relevant to that particular industry, business, or that particular sector. So there should be relevance in whatever is the information which is accumulated. There should be a stewardship built trust, that is the information um, which is collected, that should be trustworthy, genuinity. Um, so that is the stewardship built trust is the next principle. Then the impact on value is analyzed. So whatever is the impact, the framework which talks about collection of information, analyzing this information and advising this so that it can um, leave an impact or influence on the management for decision making. So that the impact on value is um, to be analyzed or understood. One second, jumping. Now, whenever you study management accounting, you put yourself in that role of a management accountant, because later on, when you join organizations, you would be working in the capacity of being a management accountant or someone who's closely associated with management accounting function. So any kind of an advice which has to be given or provided or analyzed any particular thing, it is you who would be looking into that. You would be doing that. So what is management accounting? In simple terms, when we understand what is management accounting, accounting for management is management accounting, which helps the management to take better decisions, is about management accounting. So the application of the principles of accounting and financial management, so to create, protect, preserve, and increase value. So the finance function also later on you will be learning that in even that also talks about these aspects only, enabling how, then shaping how, and reporting how. So that is narrating how. So those things only they talk about. So creation of value. Management accounting, it says that by applying the principles of accounting and financial management, what are they into? They would be creating value for the organization, creation, protection, preserving, and increasing value for the stakeholders of profit and non-profit enterprises in public and private sectors. So it's basically about this function is about creating value, and then later on preserving that, enhancing that, and take up activities which talk about creation of value. Creation of value, how do they create? Maybe by being involved in planning, implementation, then decision making, controlling if there are anything, any deviations. All of them talk about how to create and preserve value. Now, broadly speaking, organizations are of two types based on the profit criteria: profit organization, not for profit organization. So whether it is profit organization or not for profit organization, depending on whatever is their objective, when the objective is fulfilled, then that value is created and preserved, protected, and then ultimately increase the value. So this is the area in which management accounting works. So the application of principles. So basically, what is this accounting system doing? It is helping the management so that they can take better decisions, plan in a better manner, take better decisions for the organization. So that is what is the role of management accounting. um, this is See, we are talking about the difference between financial accounting and management accounting. Financial accounting is mandatory. It is for external purpose that it has to be disclosed, the accounting part of it. But management accounting is under no such obligation to follow this, to prepare the accounts. So there is no such obligation. It is basically prepared, or whatever are the tools and techniques which are adopted, that is basically for the purpose of the internal management, so that they can take better decisions. That is what is there in case of management accounting. But then it is mandatory by the regulation that they have to disclose all the transactions. There are principles to guide the financial accounting. There are financial statements which have to be prepared in a prescribed manner, and they have to be disclosed. But management accounting has no such format. Depending on the purpose for which the accounts are prepared, they are prepared in various formats. They relate to the past, they relate to the present, they also consider the forecasted figures for the future. Everything is taken into consideration. So there is no legal requirement, no set formats or rules. Main purposes are planning, controlling, and decision making. Then after that, management accounting. What are the roles of management accounting? We have planning, controlling, and decision making. Plan for the future period of time. So before anything is taken up, the first thing is planning. So management accounting helps in planning for the future. establishing the objectives of an organization and formulating strategies that can be used to achieve those objectives. So it helps in deciding what would be the future course of action, plan for the future. Then this has to be implemented. When it is implemented, at that time, if there are any deviations, measures are taken to control those deviations. So that is about the controlling part of it. Wherever planning is there, we also see that controlling would be there. They would both go hand in hand. Once planning has been carried out, targets can be set. This allows for evaluation of performance. Evaluation of performance happens when the implemented part of it is compared with the plan. So at that time, the performance is evaluated. If there are any deviations, those measures can be taken to correct those deviations. The third part of it is decision making. Decision making involves considering the information that has been provided and using it to make informed decisions. See, the creation of value starts with collection of data, processing that data into information. So that it starts with the collection of information. So now this information has been and that is taken into consideration. Now this information has to be provided for decisions by the management. When the management is provided with the information, then it becomes possible for them to take better decisions. Therefore, we see better decisions are possible because management accounting is involved in right from the time when information is collected. Quickly, we'll okay, then we have the characteristics of information. There is one acronym which is given. So if you remember that, it would be easy to remember what are the characteristics of information. Information is required. Information is needed so that decisions can be taken. So when the information is collected, that is helpful in planning. So the characteristics of information at different levels, we have the decisions are taken at the various levels, that is at the strategic level, and also when the implementation happens, that happens at the operational level. We see that strategic level is the top management, the senior management. We also call that a strategic level. Now, when information is collected, that is useful by the strategic level, where they use this information for forecasting, for forecasting purpose, and information needed for long-term planning. It is subjective, wide, and summarized. So, um, the the top management, the strategic level, they plan for the organization as a whole for a very long period of time. They are not bothered about the intricate details within the organization, but their main focus area is about long term planning covering the entire organization. So if the details are provided to them on a broader note, that is sufficient. They need not have the in detail minute details, that is not needed. So here we say that wide range of data, not in detail. So the summarized form of data, if it is provided to them, that is useful for them for taking better decisions. At the operational level, we see it is historical. So that historical, because after the implementation happens, then that is taken into consideration, and the performance is evaluated compared with the plans, and then evaluation takes place. Short term, their focus is only about until it is implemented. um, Unlike the strategic level, they are not focusing on a long term. Strategic level, on the other hand, they look at a long run, or they have that vision about how they would carry on. so that the very basic purpose of the organization can be achieved. But operational level, they are only focused on implementing whatever is assigned to them. So their focus is for short term objective, very specific to that particular point. If they cater to that requirement, that is sufficient. Then it's narrow and it is detailed. Okay. um, because they are implementing in a particular area, so those that are involved in a specific role or area, they would require information in that particular area in detail. So that is the point here. Narrow, they are, they do not want a broader picture, they just want to have the information very specifically relating to their area. Then it should be in detail. The characteristics of information are can be remembered with an acronym called as accurate. The first A is accurate. So information, when it is collected, it should be accurate, the correct one, true information. So accurate. The benefit which can be derived out of collecting this information should always exceed the cost which is spent on acquiring the information. Then complete, then understandable. It should be considered in such a way that it is understandable. Anything which is presented as information, if it cannot be understood, it cannot be evaluated. So another important point is understandable, relevant to that particular industry and business, authoritative, um, enabling them to take decisions, authoritative, timely, within the time frame it should be acquired, otherwise it's of no use. Then easy to use. What's the role of management accountant? Role of management accountant. Management accountant is someone, I mean, in simple terms, if for our understanding, someone who's well versed with every aspect, every area of the business, because he works in the capacity of providing information to the management for decision making, or he has to have an understanding about various aspects of the organization so that he can provide the information related to that area. So he is someone who should be a multifaceted one. So he should have knowledge about every aspect of the organization. So as and when anything which is required by the top management, he should be in a position to provide such information. So tomorrow you also will become the same. So what is expected of you is you should be all rounder kind of thing. So you should have a knowledge about various things. So wherever we talk about management accounting, management accountant, we are not talking about anyone else but about you only. So you put yourself in that particular position, their shoes, and then keep thinking about. So what is the role of management accountant? The role of management accountant is no longer simply reporting performance to management. That is the role of financial accountant, or gone by the days when the management accountant also used to report the information to the top management to take decisions. But now it is not only restricted to that particular point where the information is provided, reported to the management, but rather it has increased, the responsibility has increased in terms of it is now a value adding business partner, because any area wherein any kind of advice or criticism or any suggestions or anything which is required, even when you take up the case study part of it in future, later on when you start working out on case studies, you find yourself to take up that role. You as a management accountant, you as an advisor to the CEO or to the CFO or something, the question will be framed in that way. So you have to take that role and then talk about what is it. So what is the expectation? Someone who can be depended upon, someone who has an answer to everything, someone who understands the concepts thoroughly. So in simple terms, it says that it is a now a value adding business partner. That's the role of a management accountant. So his role is to enhance performance. Roles include formulating strategic plans, acquisition of finance, deriving performance and benchmarks, um, improving business system, generating, communicating, and interpreting financial information, risk management. So we see that here every aspect of it, um, the management accountant has a role to play, starting from what are the strategic plans, formulation of strategic plans, how the finances are acquired, how they are invested. So invested so that profits can be maximized, deriving performance and benchmarks, then improving business systems, generating, communicating, and interpreting financial information, risk management. The finance function, the finance function, even those who are the, um, I don't know what are your years, those who have done are in the second year, I think. Some of them, Nihal, Kirti, etc. They have very recently done E1 and P1. So I don't think they require, but those who are doing that, this is what you would be looking into the finance function. What is the finance function? See, there are three roles of finance function. One is about enabling how, shaping how, and narrating how. So that part of it. Um, now, all these things house are about the value creation, preserving, um, enhancing the performance. So that is the that's the role of finance function. So here we see that the role of finance function starts with dedicated business partners are a part of the business, strong business relationship, detailed knowledge. We have something called a shared service center wherein the work is carried on for all the units of the organization, instead of working in the same office or in the same organization located at one place. The operational work is all carried out at one particular location for all the offices or all the organizations spread across the region. So here what happens is when the work is done at one particular place, that is considered to be as a shared service center, because all the operational work is carried on at one place. So that will be helpful in terms of saving the cost saving measures can be taken up, and then it is useful in um, cost saving, um, because otherwise if work is carried on at individually each location, the offices of the organization which are set up in different locations individually under each location, in each location, if the work is carried on, investment is required to that extent. Everywhere the investment is required. Rather, if all the investment is made at one particular place, the equipment and other resources are required, and the operational activities carried out at one place, and then that is moved to the other organizations which are located at different places, that would be a benefit thing, that is cost saving. Then all best practices can be followed when they are depending on shared service centers. Then consistency can be maintained, because it is only one particular location from which the work is carried on. Then we have a concept of business process outsourcing. Outsourcing here, um, see, a shared service center is one unit of the same organization. It is kind of an internal work only, but only thing is the location is at one place where the work is carried out. But in case of outsourcing, it is an external entity with whom the orders are placed. So that is business process outsourcing. This is also cost saving, because the outsider entity or the external entity would have achieved the efficiency, the economies of scale they might have achieved. They might be experts in their role and position. So it is cost saving. Then, because they are specialists in their specific area, so we see that specialist work is carried on, and releases capacity. So instead of investing into the resources to See, outsourcing is not for the entire product. Generally, we have to remember one very, very important point is outsourcing is with specific reference to uh, the component of the product. It is not the entire product. It is only one component of the product which is outsourced. So, when one component is not produced, some part of their capacity would be available wherein they can take up other activities. Um, what are the fundamental principles in terms of ethics? See, we have the fundamental ethical principles: integrity, objectivity, confidentiality, professional competence and due care, and professional behavior. These are the principles, ethical principles organizations should follow. Starting with integrity. What is the meaning of integrity? Integrity talks about doing the right thing even when they are not being observed. um, See, even when there is no one to observe them, even if there's no one to uh, look into that aspect also, being right all the time, being right, that is about the integrity, doing the right thing at the right time. See, even if there is no supervision, no one to verify that also, doing the right thing is important. So that talks about the integrity. Now that should be one value which everyone in the organization have to adopt. So that's about the integrity. Objectivity is being truthful, unbiased is objectivity. So taking up decisions in an unbiased, impartial, and taking up the rightful thing, that is truthfulness. That's objectivity. Confidentialities, the information which belongs to the organization has to be maintained as confidential information. At no point of time this has to be disclosed to others. In only one situation this confidentiality can be broken, or there can be a breach of confidentiality in situations when the law requires them to share that confidential information. In such situation only there can be a breach of confidentiality, but in all other situations the confidentiality has to be maintained. It should not be shared with anyone, even with their close family and friends. By sharing this information, if others can be benefited out of that, so that should not be taken up. If it is confidential for the organization, has to be maintained in that manner. It has to be taken care and then maintained it as confidential information. Then we see professional competence and due care. So people who join the organization have to have that professional competence, and then um, they have to enhance their skill set. So when they join the organization, they cannot expect to be the same and it's perform in the same role and position for a very long time. So they have to enhance. It is the responsibility of every individual joining the organization to enhance their competence, their skills, and take care of their professional qualifications and skills. That is professional competence and due care. Then behave in a professional manner with everyone. That professional behavior is what is expected of them, and they have to behave in that particular manner. So um, CIMA has mentioned the ethical and professional standards. So these are the ethical principles, the ones which we have just now discussed. They are the ethical principles. So committed to upholding the highest ethical and professional standards. CIMA is globally recognized as CGMA. So you are, all of you would be on successful completion of that, you would be earning this qualification. So now the next part of it is about the costing techniques. P1 talks about the same thing. We very recently your seniors have done, and who I think they have done this class with me only. So one more time, they it is kind of a repetition. So let's look into what do we have, what is the content we have here under. Cost accounting. Under costing, we see what are the definitions. There are certain definitions which have to be learned. So first part is the definitions, the classification of cost. Understand the meaning of what is relevant cost, marginal and absorption costing, overhead analysis. These are the topics which are covered under costing, cost accounting. Let's see what are the definitions. The definitions of what is a cost object, what is cost center, what is the meaning of cost unit or composite cost unit. First one, cost object. What is cost? A value which is the identified with the product or service, we call that to be as a cost. With anything, if there is any amount which is identified, we call that to be as cost. So there are certain definitions, all of us have to be aware of that, because this is the terminology which would be used in cost accounting. This is what we are going to learn there. Okay. The first one is what is a cost object, cost object. Okay. Anything for which cost can be ascertained. It could be a product, service, center, activity, etc. What does it mean by object? So any entity with which the amount of cost can be identified. It is chargeable. It is attributable. We call that to be as a cost object. What is that entity? That entity could be a product, a service, a department, a center, an activity, anything, group of people, anything with which costs are attributable, we call that to be as a cost object. So this cost object could be a cost center or a cost unit. What is cost center? A product or service location, an activity or piece of equipment for which costs are ascertained. So a cost center, it says that a product or service location, an activity or piece or equipment for which costs are ascertained. So that is a cost center. Unit is per unit of a product or service. So when we find out what is the cost per unit of a product or service, we call that to be as a cost unit. What is a composite cost unit? Composite cost unit is often used in service organizations. Okay, that is these are the terminology which we understand. Examples of cost objects, cost centers, and cost units are given. Cost object is a product or service, activity or cost center. But then what is a cost center? Department, function. It talks about a location. So department, function, item of equipment or an activity. So that's a cost center. A unit is either it is a product or service. Okay. Now we're going to look into the classification of cost. Classification of cost. Um, the classification, if it is based on nature, elements, behavior, and function. So there are many types of classification, but whatever is covered in the syllabus, so we are going to look into that. Later on, anywhere if it is needed, it can be further classified. Some other categories also can be included, but as of now, the classification what is given is based on the nature, element, behavior, and function. So the first one, based on the elements of cost, there are three elements of cost in an organization. The elements are material cost, labor cost, and expenses. There are three elements of cost. Anything which is acquired for the main operational work, that is the conversion of material into finished goods. So whatever is the material which is acquired, the inventory which is acquired, that is called as material cost. The charges which are paid to convert this material to finished goods, we call it as labor. Any other cost which is neither labor nor material is categorized as expenses. So that's one classification. Based on elements of cost, there are three costs: material, labor, and expenses. By the functions we see broadly classified, we classify the functions of the business as production and non-production. Under non-production, we have administration, selling, and distribution also. So based on the function, the cost can be categorized as production cost and then non-production cost. Production cost is another term also which is given called as product cost. Non-production costs are period cost. Why do we call them as period cost? Because usually these costs are not connected to the production activity. They are incurred in the business to support the business activity. They are incurred per period. Whereas production is to produce some X number of units, what is the cost which is incurred? So to produce 10,000 units, what's the cost incurred? So all of them are connected to the production activity carried out in the factory premises, and those costs we call them as product cost. But non-production costs are not, see, even if there is zero number of output also, these costs are incurred as they are, or many a large volume of production is taken up also, this would be incurred regularly. How are they incurred? They generally incurred for a period of time. Let's say admin costs are there. Admin costs for a period of January, February, so on. So they are incurred for a period of time. They are not connected to what is the production activity which is carried on in the factory premises. So we also non-production costs, we also call them as period costs. Production costs and non-production costs. Then based on the nature we see that this is also called as identifiability. We see that there are two different types of cost. One is direct cost and indirect cost. Direct cost, if there is an identifiability with a particular thing, we identify what is the cost. There are certain costs which are incurred as a common cost or a joint cost. They are not identified. Let's say factory rent is paid. Is that rent paid only for one particular department or one product or one service? No. All the activities which are carried on in the factory rent is a common cost which is incurred. But whereas, let's say, material cost is there. Material cost is identified with the product. For that, for the production of product A, how much material is required. Identifiability is there. To convert that material into finished goods, if the worker is paid per unit basis, identifiability is there. 1 unit of the product to manufacture, how much is the cost which is paid. Identifiability, when it is there, we call that as direct cost. Identifiability is not there, it cannot be identified with any cost object, then we call that to be as an indirect cost. They are incurred but not identified with any particular cost object. So they are incurred as a common cost or a joint cost. What has to be done? These costs have to be divided and distributed. For example, supervisor salary. What would we do that? So how much time the supervisor has spent in the production of product A, product B, take that and divide and distribute. They have to be divided and distributed. So indirect cost cannot be economically attributed to a particular cost object. So because they are not attributable, we have to divide and distribute them. That those costs are called as indirect costs. So the sum total of all the three direct costs, we call it as prime cost. The sum total of all the three indirect costs, we call them as overheads. Material again can be classified as direct material, indirect material. Labor also direct labor, indirect labor. Overhead expense also direct expenses, indirect expenses. So the three parts of the direct cost, direct material, direct labor, direct expenses, together we call that to be as prime cost. All the indirect overheads of material, labor, and expenses, we call them together as overheads, overhead costs. So this is a summarized format of the cost card or cost statement, cost sheet, whatever you call. This is a summarized version. So we start with mentioning what is direct material, direct labor, direct expenses. When we add all three of them, it's called as prime cost. Then all the indirect costs, which we also call them as overheads, they are now accounted, but they are not accounted based on indirect material, indirect labor, and indirect expenses, but rather the overheads are accounted based on the functions of business, that is production overheads and then non-production overheads. So this is the summarized format of a cost sheet or a cost card. Then one another classification of cost is based on behavior, cost behavior. So cost behavior, costs are classified as fixed cost, variable cost, semi-variable cost. But the nature of fixed cost is not the same. Till they reach the maximum capacity, it would be the same, but beyond that, it would change. So therefore, for that reason, in the long run, fixed cost also becomes a stepped cost. So what does it mean? Let's look into that. So very broad note, if we talk about, there are only two types of cost. One is a variable cost, one is a fixed cost. But otherwise, we also consider that to be as a three types of cost: variable, fixed, and semi-variable. Now, the fixed is not the same in the long run because fixed also would vary, but it will not vary proportionately. So we call that to be as a step fixed cost. What are they? Fixed cost is a cost which remains fixed within the relevant range. I'm sorry, it's jumping. Fixed cost is a cost which remains the same, which remains fixed within the relevant range. What is that concept of relevant range? Relevant range is the maximum capacity at which the operations are taken up is called as the relevant range. So it says that certain activity limit is known as the relevant range. So all the resources put together, whatever is the maximum output which can be produced is mentioned to be as relevant range. So within this relevant range, the cost, the total amount of cost would remain the same. So it's the same from zero number of units. So right at the time when the production is still to be started, at that time whatever is incurred, it would remain the same until it reaches the relevant range or the maximum capacity. It would not vary. Therefore, it's called as fixed cost. Okay, so if the total cost is remains the same, as the activity levels keep increasing, the fixed cost per unit decreases. So what is fixed cost? A cost which within certain activity limits is not affected by fluctuations in the level of activity. So this is the curve which we see. It remains the same. It remains fixed until it reaches the maximum capacity. It doesn't change. It doesn't vary. But on the other hand, we see variable cost. On the other hand, we see variable cost is a cost which varies. Variable cost is a cost which varies proportionately. See, um, at at zero number of units, it is zero. No cost is incurred. But as the activity level keeps increasing, we see that the cost, the total variable cost also keeps increasing. It increases proportionately. So that's the meaning of variable cost. Um, then what about the per unit cost? So now when we talk about what is the per unit cost, since the total cost is the same, as the activity level keeps increasing, we see that the cost keeps decreasing, fixed cost keeps decreasing. Now it doesn't decrease be, beyond zero, below zero, it doesn't decrease, but it decreases until a point of time and it stagnates there. So that is fixed cost per total fixed cost, and the fixed cost per unit keeps decreasing until a particular point of time as the activity keeps increasing and it stops there. um, Rather if in the long run we can see that the fixed cost per unit again increases also. So that is the behavior, that is how it behaves, or that is how the fixed cost per unit changes. The total fixed cost is constant over the relevant range, but the fixed cost per unit reduces as the level of activity is increased. This is because the same amount of fixed cost is being spread over an increasing number of units. Um, a simple example is given. If total fixed cost, if it is 5,000, as the number of units keep increasing, we see the cost per unit keeps decreasing. As the denominator keeps increasing, the value keeps decreasing. So that is what is explained here. Then we see the variable cost, because let's say if the variable cost per unit is 5, every additional unit also it will be incurred at the rate of 5. So cost per unit, variable cost per unit would be the same. If whatever is the value, per unit value, once it is known, that per unit value would be the same for any number of units. So starting from 0 number of units till the nth unit, we see that the variable cost per unit would be the same. Then we have the stepped fixed cost, because fixed cost will remain the same within the relevant range. So let's say that if this is the maximum capacity, so until this capacity, the amount of fixed cost would remain the same, which means that the resources when they are required, like plant, equipment, machinery, land, building, then material, other resources, all these resources put together, how much is the output which can be produced. So that's decided to be as the activity level at the maximum capacity done. But what if they, with these resources, let's understand that the capacity is available for producing, for example, a simple example, 1 lakh units. So if they can produce 1 lakh units, but let's say if they want to increase their activity level, they want to take up the production of 1 lakh 50,000. So in that case, is it possible to produce 1 lakh 50,000 within this range? No. Maximum itself is 1 lakh units. So to enhance the capacity, additional equipment, additional resources, space has to be provided. Other things also have to be provided. So here we see that the fixed cost will suddenly increase. It increases, but then it would be the same until the next relevant range is applicable. Then if they want to take up the production beyond that range also, then again it enhances, it increases, and then it's the same. So the fixed cost in the long run, we see that it takes the shape of a step step fixed cost, or we also call that as the step cost. That's applicable in case of fixed cost, wherein fixed cost is the same within the relevant range, but once the range crosses, so at that point we see that this cost also varies, that increases, then the increased amount is again fixed till it reaches the next level. So we call this to be a stepped fixed cost. Then we see there is another thing called as semi-variable cost. What is a semi-variable cost? Semi-variable cost is a cost which is partly fixed and partly variable. A component of the cost is fixed and the other component is variable. So we see that that's partly fixed and partly variable. Best examples of semi-variable costs are the postpaid mobile phone, um, electricity charges. So we see that these are the examples of semi-variable cost. So there is one a part of it which is fixed. So this is fixed, but over and above this, we see that the cost keeps increasing, which is variable component. See, like postpaid, there is a basic plan. So within that plan, there are certain facilities which are given free. So if the usage is within that limit, then it is the fixed portion. But if the usage exceeds beyond that, for the excess usage, we see that the cost again varies. So it's a semi-variable cost, partly fixed and partly variable. Now, if there is a semi-variable cost, how do we separate them? That is methods to split between fixed and variable elements. These are the methods which are available: high-low method, scatter graph method, and regression analysis. See, we have to work out questions, but what we'll do is we'll proceed further with the explanation. Let's take up one example question which is given here and understand how we can use high-low method to separate the semi-variable cost. Why would we want to separate them? One second. There's some problem. You be here only. Maybe for a minute or two, I will disconnect. There is some issue here. I'll join back. Please don't leave the class.